Shout out to the live.
We are live.
We are live, dudes.
That was really fast.
Yeah.
I'll pull up the questions real quick.
Art. What's up, guys? Welcome to December 5th, I believe. And Lucci is unfortunately, well, not unfortunately, he's teaching a webinar, a very important webinar. So you got Pete and Charlie here. Whether that's a good thing or a bad thing, we'll let you guys decide. We have all your questions queued up, but I know that there's a couple things that we want to talk about before we jump into the questions, especially stuff that's going on with regulatory issues recently. Pete, you want to hop into the MSN money thing?
Yeah, so hold on, let me pull it up real quick. So MSN Money actually finally reported, first of all, congratulations to Chaim Bodek, Scott Patterson, and Calibrated Confidence,
The fight
Eric
continues.
Hunter, all these guys who have been fighting for the overall market reformation, movement. Congratulations, also Sang Lucci crew. Luis pretty much made statements that the Reg NMS will be under scrutiny officially, and this is a relatively big push. SEC has been looking at market structure for a bit, but they haven't necessarily said we're going to check out Reg NMS specifically. MSN even quotes here that the commission should immediately revisit the Reg NMS standards.
That's a direct quote from one of the members of the SEC.
Aguilar even says that the SEC should overall just review Reg NMS and to see if it's created too much fragmentation and fostered an unreliable complexity in markets. This is super awesome.
As well as whether increased speed has benefited investors.
Yeah, and so overall, super happy about this.
It's also the kind of thing that it's like, when you guys see someone speaking openly about something like this, the amount of activity that's going on underneath the surface, the things that you guys don't see, is usually pretty insane, right? So if the activity is so intense that it's actually bubbled up into the public's view, then some pretty serious stuff is going on behind the scenes. So.
And just so everybody is clear, like, kudos to the SEC, and props to them for even trying to take on any type of regulatory mandate for the markets at all. I mean, this is there has been an umpteen amount of historical information of just collusion in markets in general, and something really interesting here is that that Reg NMS was created in efforts to help investors. We're not saying that SEC did a shitty job. We're not saying that there's collusion there. We're saying that it's really interesting that they're able to say, hey, we're going to come back and look at this, see if we actually threw some things in there that might have been too complex and caused some weird loopholes. And it's a good effort, and we really appreciate Luis Aguilar for really stepping up to the plate and doing something about it. So onwards and forwards to the questions we have. Some guys asking about SCTY. I'm not going to answer that question. SCTY overall, if I say anything or anybody else out there says that they're long or short, we'll move this freaking name. Okay, it's not a very heavy name. Solar City, all the solar stocks have been hot, all that kind of stuff. Mobile players are in it, but be careful. Momentum dries out immediately once bull market's over. And as you can see, tomorrow's super fancy big numbers that come out are supposed to be the most important numbers of all time for the 50th freaking time, and we'll see what happens. So another question here is somebody's asking about historical options pricing on weeklies, and asking if they are priced right or too expensive. Historical pricing is kind of hard to peg, John. Overall, for instance, if you have the S&P 500 trading at 180 versus 170, and you're looking at a historical pricing of Apple that trades at, say, 500, and then you look at it again afterwards at 500, and SPY is trading lower, naturally it will be higher priced. And looking at historical pricing is less important than actually looking at current pricing and comparing overall how much further the actual pricing of the options are. Again, something we teach in our classes. There are actually real ways to just by hand and just by an eyeball to actually calculate overall where your price should be. Obviously, there are volatility factors and time decay factors involved, but no, I would not pay attention to historical pricing. I pay much more attention to looking at the actual options book and kind of seeing the relative pricing between each other, and that would give you a better gauge of volatility and time decay, gamma, and all those sorts to see if they're actually a worthwhile calculation there.
What happened to our comments too? Where the
Comments are?
No, that's
You
Twitter.
click so many things that the comments get
I like
clear.
it. I got ADD, man. I gotta have
You're
a lot
just
of-
clicking away.
I'm getting rid of PowerPoint.
All right. Okay. So all
What
right,
happens
next
when
question.
you live with the people you work with?
Next thing we've got here is somebody's congratulating us on a killer month. Fantastic. Thank you very much.
Thank you.
Somebody's also saying that there is the markets are at different conditions right now. Momentum trading has been slammed recently. Breakouts aren't really working. The real question here that they're asking is how do we see ourselves reading the tape when markets are slowly gearing towards dark pools? So I can tell you a little bit about that from a technical standpoint. I'll try not to jargon on it too much. So overall, in tape reading, very basic tape reading is always, looking at the tape and level 2, right? And you're always looking for if bids are being held up and if, where the actual prints are going off. And so when you look at these actual prints, it's really important for you to understand which way they're leaning. So overall, there are some tape readers out there. What they do is actually they look at the bid and the offer, say it's 8 by 801, and they'll actually look to see if the dark pools are printing closer to the offer or closer to the bid. Okay, so there's actually people out there that have filters on their time and sales that will get only the dark pool fills or only the multi-decimal fills versus just the large order fills versus extremely large order fills, and you'll be able to tell exactly what's happening there. I don't believe you're ever going to get a market that is fully dark because you'll just never know where the actual market is. You need to actually display a bid and an offer. If somebody wants to walk a stock or hold a stock up and likes the price and there's a limit order, it's very important that it shows up on the book. And I guarantee you that SEC is on it, that they need to curb the usage of darks to allow more transparency in the markets. Now again, darks were created for multiple purposes. There's obviously two edges to the sword. One edge to the sword of dark pools is to help big guys get in without having to spook the markets and move it around. But at the same time, HFT and smarter guys out there are actually looking at this, looking at the dark pools and gaming those dark pools as well, going back and forth. So just know that whenever the SEC comes out with new regulations, even the OCC comes out with regulations, it's one hand is trying to benefit investors and long-term players and real actual players that want to buy and sell. And then on the other hand, what happens is that HFT and super professional predatory traders are actually going to game that system. There's always going to be this back and forth, back and forth, back and forth.
It's almost the exact same thing as Reg MMS, in principle, and that it was created at first to protect people, within the market. But anytime you have companies with the kind of backing, the infrastructure, the brain power, collective brain power of a lot of these top HFT firms, like they're going to find a way, around it. They're going to find it. They are the piranhas. They're the hyenas, in the whole ecosystem, and they're going to find a way to get to those whales or those elephants. That's how they eat. So there's always going to be that arms race between regulation and these firms.
Yeah, and something that is currently being discussed, and again, this goes to another thanks to Scott Patterson out there. He commented, I believe it was yesterday, about the Volcker Rule, and so Volcker Rule
It was
overall,
on C-SPAN, guys.
It was on C-SPAN.
Yeah. Just Google Scott Patterson C-SPAN Volcker Rule, and you'll see like a 40-minute interview with him, on C-SPAN. He lays it all out for you.
And overall, again, like these big banks, they have their customers, they have their market maker unit, they have their internal unit, they have a proprietary unit, and all these pieces are there to try to make money for the firm as well as try to help customers out. And also there's benefits for helping their relationships with the exchanges as well, but we'll get to that in a second. Volcker Rule overall is just trying to eliminate proprietary trading to prevent oversized betting and just
London whale kind of stuff.
London whale kind of nonsense. It's questionable if that's actually going to really curb it, because again, just like Scott Patterson, we actually tweeted at him the other day asking about what happens to these firms when they have to let go of the prop side. Well, it's simply just the moving of hands. If you have a bank that is the broker-dealer, they have a market maker unit, a prop unit, and they have customers as well and partners on all these customer sides, what side do you think that they're going to move their prop unit? They're simply going to shift it to the other side where it's going to be one of their customer accounts. Again, this is just what I think is a logical decision for them to do. In general, I think that there may be larger issues here that are not specific to a London whale oversized betting type of thing, but much more in regards to payment for order flow and for internalization.
Yeah.
So, a lot of times what you guys need to understand is that when you occupy such a large part of the markets, what they're going to try to do is match your orders up, not have to pay, not have to show up on the tape, all this type of stuff, and try to internalize flow, ultimately to just gather market share. And moving it from a prop arm that may be trying to internalize flow, trade against their customers, can ultimately be done on the customer side too. And just so everybody knows and understands the marketplace these days, I believe that the Volcker Rule will help curb, blame on a bank for taking bets.
Which is the intent, anyways. Yeah, it's a political rule.
It's a political rule. I think it's in the purpose of helping the bank not be the again, you have the American spirit ingrained in J.P. Morgan and Jamie Dimon.
I was going to say Jamie Dimon. Yeah.
He is the epitome. I love the guy. The way that he actually presents himself, but you can't tarnish that flavor of American politics there. So obviously they're going to move it towards the customer side. That every Goldman customer that comes in that's big enough can almost be considered a partner of Goldman Sachs. Right. And this is it's going to be interesting to see where it goes. And we actually feel the backlash of the Volcker Rule as well. And it might not be directly related, but the prop industry for boutique broker-dealers, again, like you deposit money, you get to trade on broker-dealer leverage, all that kind of stuff, that has been completely wiped out of the industry recently because of Series 56 enacted by the CBOE to just really kind of curb oversized betting, has really taken out a lot of human interaction in the markets. And something that we see just as prop traders and as professional traders and as just young guys on the street and just like keeping our ears to the ground is that big customers that put out large orders and actually trade are very, very seldom out there. You don't see people actually interacting in the markets. Some of this leverage kind of is needed for hand traders to just interact in the markets. Yeah. And this comes all the way. You can have this kind of circular argument over and over and over again, but it comes down to a point of, what is the market in general? It's something built on. I personally think it's a gambling arena. It's the legal Vegas out there, and
that's what it's become. Yeah, that's what it's become.
It's what it's become, and
that's something that they hit on in dark pools really well. That Scott Patterson, not to shout out to you, Scott, like 50,000 times in this, but you covered very well in the book Dark Pools that. Originally the point of the market was to be a place where, people who had ownership in a company could offload that onto, and lock in their profits or whatnot, where companies could raise capital for operations and whatnot, and where, buyers who wanted to get involved and participate in a company's success or make a bet on a company's success could go do that. And now, you know, it's exactly people from our generation. I mean, Pete and I are 26 here. We look at it as more as like the stock market's like basically a casino. You know, that's sort of what it's become, and that's what they're trying to cut down on with, you know, the Series 56. You know, and really trying to say, okay, if you're going to be trading at a proprietary trading firm, if you're going to go in and put up $5,000 and you're going to get you know, 40 times leverage or whatever, you need to at least have a license in order to be able to do that. And then obviously with Reg NMS and what we're talking about at the beginning of the broadcast, like they want to cut down on high frequency trading of just that doesn't make any sense, and that's predatory towards, you know, the people who are actually in the markets for investment purposes.
And it's just I mean, it's unfortunately, regulating the entire market is a very freaking tough thing.
It's at this point, it really is. I think it's just completely political, right?
Yeah,
I mean, it's just like what they're trying to do. Yes, I think they're trying to fix the system, and I'm not trying to knock them. I commend them for that. But they're trying also to. It's a marketing effort, right? I mean, they're trying to remake the brand of the U.S. Stock market. I mean, now this is 5 years. 5 years? Lehman collapsed 2008.
Yeah.
Yes, this is 5 years now after the collapse of Lehman, and that was like, you know, that's like you know, Walmart having a case of like a store burning down and you know, or shipping merchandise
crash. Like everybody is all about the repairing of the markets, and that's great. But it's just that, you know, there's so many relationships involved. Again, you know, we might actually have another show where we actually show you kind of the history of collusion in the markets. And we're talking about things that have gone back to the 80s. SEC comes in and fixes it. It switches hands, and then it's like the Batman quote, you know, like you stay around and be the hero long enough, you're going to end up being the bad guy.
Yeah.
And it's all about your market. It's all about your market share. How much do you have internally as volume for yourself?
Yeah.
And so like it's going back and forth, and it's really dangerous. And you know, every day, you know, we at Sang Lucci, we tried not to take overnight positions because you just have no freaking idea what the heck is going to happen. Market fundamentals. What market fundamentals? You know,
unless your time frame is
umpteen long.
Yeah, I mean, you really do need to be a true investor if you're looking at fundamentals.
Mm-hmm.
And okay, so we're seeing some stuff come through the chat. Yeah, guys, I mean, if you have questions, if you're in the chat for BTFD.TV, definitely put them in there. Yes, Gamba, we can see this. You're an idiot. We got Joshua Roberts is saying markets have been deliberately remolded into a casino. Yes, HFT crackdown will capture any remaining little guys and their rigs while codifying the ball changeover metrics. I think it would be surprisingly easy to start from scratch and rebuild global markets from the ground up.
I think that's a very interesting thing, Joshua. I think there are groups out there that are pushing for this.
Yeah.
We have no problem naming, like Stuxnet, for instance, like they and like the actual I think what's the something war on Wall Street? What are they calling it? Anonymous and all those guys, and the ones that are petitioning Wall Street. Some of those things, like, you know, politically on the outside from a marketing standpoint, they look horrible. But the efforts of trying to remodel the markets or even have a new type of market is, I don't think is, you know, I think a couple guys from Fermilab could probably help make it.
Put a Chaim
Bodek in there. But overall, yeah, I agree. But the problem is that when you have an auction process and you have levels of transparency and levels of non-transparency, you will have relationships that are built and collusion efforts, and then it'll just be arguments back and forth, and it's just like it's always going to keep revolving and revolving, and it's going to come back and forth, and it's really about, you know, you're never going to get to a fully fixed point. And again, you know, thanks to the SEC for, you know, pushing these efforts, and we really respect that you're doing this. And thanks to all the guys that are actually putting out the effort. But for everybody else out there, all the traders, get your freaking education on. You know, come look at what we're doing. Look at what all the other guys are doing.
It doesn't have to be us. There's plenty of people out there.
There's plenty of people out there.
Yes, yeah.
Definitely. And
follow Nanex on you know, Twitter. Follow David Lauer is a smart dude. You know, who talks about this a decent amount. There's forums all over the place. Tab forum, go there, check that out. You know, Scott Patterson, anything he's written in the Wall Street Journal or his books. Just educate yourselves, guys, because if it's your money that's out there,
And just know that the things you hear on the television and the things that you're listening to, they just always take it for a grain of salt. Always think about what you're doing, and always think about where your money is going and who the big players are, the politics involved. I know this may not be something that will greatly affect you, but it's really important for awareness. We as Sang Lucci, and even with Chaim Bodek and with everybody else out there, it's just about market awareness and educating yourselves. You don't want to just throw darts into the markets.
Yeah, and I think he sees Josh is saying we need real markets. Yeah, I mean that's something that as we talk to guys who are older, who've been around for longer, maybe still able to run boutique broker dealers and stuff like that, raising capital. They're actually working with investors. They are they're basically just sort of like, I cannot believe this is what markets are now, because they've really lost their faith in the system. And I think maybe it's turned around this year, but in the last 5 years, if you actually looked at the number of IPOs that were taking place in the markets, it was going way down. The number of IPOs that were occurring. And
what's the point? Why would you go public?
Right. You don't want your stock to be publicly traded if you're a CFO or CEO of a company. You don't want them to be subject to what's going on out there. So
yeah.
Let's see if we can get at least another question. See if any more are coming in on Twitter. If I can find out where that is. I don't know what that is about.
Sassy Spy is trying to see Lucci in some Lululemon pants. I don't know what that's all about.
Yeah. What's going on? What is he? Okay, not that one. Proportion. Oh, I know you trade with some big size, but what is the proportion of your capital? Would you recommend that traders stick to risking 2% of their capital, though they are obviously using some more than 2% to purchase the option? All right. I'm going to speak to this real quick, and then Pete will get into it more from a strategic standpoint. We trade extremely large size for the amount of capital that we have. I mean, at the beginning of November, I believe our account had about $1 million in it. And so for anybody who sees the size that we put up, that it was pretty aggressive. I mean, Lucci trades aggressively. Pete is risk manager for Lucci, and that's like an oxymoron. But I think for anyone who's starting out, yes, keep your percentages small. Like absolutely. I mean, Lucci himself says openly, I would never recommend you take that much risk. I don't think that there's, and Pete, you can speak better to this. Like I don't think that there's like just an ironclad rule. I mean, there's books out there. There's strategies. What is the turtle traders? I mean, that's kind of a cool thing. That was a system that was proven very well. Earlier on, and that's there's all sorts of systems out there that will put inherent limits on that. It's just really up to you to reconcile your risk tolerance with your strategies.
And the problem with talking about risk is also that there's risk management that entails position and also your account size, and then there's also your psychology. So you can have a great system, you could just completely disobey it.
Right.
And so part of turtle trading and all these like lower risk type of trading styles is to also try to assess for your user error. If anybody out there actually really trades, you probably know that you obey your stops maybe under 50% of the time. Okay, that's just how it is. And again, this comes back to the casino gambling kind of thing going on out there.
It's also just human nature, man. I mean, it's
it's
a hard thing to let go.
Human nature.
Yeah.
And again, start small and know that the risk management isn't just there to cap you on your losses, but it's also trying to teach you risk and reward in your heart and in your mind in terms of like how you feel when that happens. And I know that sounds so mushy, but it's literally like, what is the emotional response, the biological response that goes into your brain and says, "Oh, that was a huge rush, and I got money out of this," versus going smaller size and just getting used to the freaking thing.
I remember Pete talking about this. This was when we were still in LA. So this is almost 2 years ago, and he was talking about how when he started to really understand how to manage his risk, he understood. he was correlating the physical sensations of his perception of what was going on in the markets to what was happening like in your body. I mean, like traders, a lot of traders trade because they're like adrenaline junkies, man. I mean, they want the rush, and there's almost like a way to quantify what you're experiencing because it's physiological, I mean, that's why I'm always harping on meditation, and that's why guys like some of the best investors in the world, Ray Dalio, blah blah blah, they all meditate. It's just one of the many ways you can build up a sense of self-awareness. Pete, you meditate all the time. You don't talk about it, but you do. Just because you got to be able to understand how what's happening there is affecting you personally. Because dude, no matter what your system is, just what Pete said. It's your psychology that's placing the trade. Your brain is the one hitting the buttons, So if you don't have control over your brain, your sensations, your emotions, like it's not going to be able to execute on a system.
Yeah, because when you trade, you have to understand over time. When you look at your stats, I would say about 80 to 90% of those stats is a reflection of yourself onto your trading. Okay, and it is all up to you in your mind how you can internalize this on a biological response. And we try to we have on our 13th day of our class, we have a PhD neuroscientist that teaches it and tries to help you guys kind of sort out the most ridiculous things going through your head. And like just I know we're short on time here, but like we used to get thrilled if we made $40,000 in a day. $40,000 in a day is like, oh, I looked at it, okay, it's on to the next thing now. $100,000 days like that now. If we lose $100,000, it's like shit. Oh, we got to keep going. That's it. And over time, it's conditioning, and it's unfortunately just going through the losers and knowing that you don't want to feel those feelings anymore, and knowing that if you are on a winning streak, that the likelihood of hitting a big loss is sooner. You need to be able to assess that and pull back. Even while you're on the top. Who was that football player who was like? He had a twin or something like that, and he left football when he was at the top of his game or whatever. It starts with a T. I don't know.
You're not talking about like Barry Sanders, are you, the running back?
No, this is a recent guy. He was in blue. I don't know, but anyways, like it's all about getting.
Oh! You're talking about the guy who was he was running back for the Giants, and then there was the dude, his brother, twin brother's a Buccaneers.
Yeah, the brother,
Buccaneers.
Yeah. But overall, it's just like you assessing to yourself, hey, I'm on the top right now. I should pull back and relax for a little bit. Yeah. And we relate it to sports. We relate it to just in general how you should treat your life. And it's again, just always be in assessment mode. And it's very, very hard. Again, like in meditation, it almost allows you to step aside from your ego and try to look at things from a third-person, omniscient view. And again, it's very hard to do this if you don't try to train yourself for it, because you're always attached to your neural responses of, boom, there's the adrenaline, I love it, let's go for more. Half the time, you can make money in the morning, and then you say, oh, I'm making money in the morning, I'm going to keep on trading in the afternoon. Do you know that you have decision fatigue? Do you know that once you load up carbs at noon that it affects you a certain way? No, you probably don't even think about these things. And it's very important for you to always be assessing what the heck is going on in your mind.
Yep, guys. That's really important to us. So.
Yep.
I mean, it's 5 o'clock now, guys. So unfortunately, Tiki Barber. That's it. Yeah.
Tiki Barber. Yes.
Shikamba.
I told you it was T.
Give us that answer. God, you're killing me. Yeah. Tiki Barber. All right. Tiki and Ron. Yeah, whatever. All right, guys. I think we're about out of here. They're gonna kick us off here. I'm sure they have someone else coming on, but
appreciate you guys coming on. Again, thanks to all the guys who helped out. Calibrated Confidence. Big props to you. Thanks for doing this with us. And we're looking forward to coming back on. Again, shoot us tweets at Sang Lucci. At the Professor SL is at SL Professor.
Yeah, the Professor _SL at Sang Lucci. Sang Lucci Mailbag. Email him. Email to mailbag@sanglucci.com. And we're coming on every Tuesday now too. So last Tuesday we had Brian Weiner, who is former head trader at Trading Machines with Hein Bodek, was on with Pete. They were talking about hedging and volatility trading versus delta trading, and that whole that whole, what do you call that,
Mess.
chasm. Yeah. So join us Tuesdays at 4:32. So.
All right, guys. Thanks for coming along. Catch you soon.
Peace.